Hello everyone. Thank you for listening to me reading the academia paper. Today I will read the introduction part of the paper, Inside the Black Box, the credit channel of monetary policy transmission. This paper is written by Ben Bernanke and Mark Gertler. It is the first paper that officially proposed the existence of the credit channel. So in the old time, it is the interest rate channel, but now the behavior of the financial intermediaries also affect the monetary transmission. Okay, let's begin. Most economists would agree that, at least in the short run, monetary policy can significantly influence the course of the real economy. Indeed, a spate of recent empirical research has confirmed the early finding of Friedman and Schwartz, 1963, that monetary policy actions are allowed by movements in real output that may last for 2 years or more. There is far less agreement, however, about exactly how monetary policy exerts its influence. The same research that has established that uh, changes in monetary policy are eventually followed by changes in output is largely salient about what happened in the interim. To a great extent, empirical analysis of the effects of monetary policy has treated the monetary transmission mechanism itself as a black box. However, conventional views of how monetary policy works are, reality available. According to many textbooks, monetary policymakers use their leverage over short-term interest rates to influence the cost of capital and consequently spending on durable goods, such as fixed investment, housing, inventories, and consumer durables. In turn, changes in aggregate demand affects the level of production. But the textbook story is incomplete in several important ways. One problem is that, in general, empirical studies of supposedly interest-sensitive components of aggregate spending have in fact had great difficulty in identifying a quantitatively important effect of the new classical cost of capital variable. Indeed, the most common finding is that non-new classical factors, for example, accelerator variables such as lagged output, sales, or cash flow, have the greatest impact on spending. For recent surveys on the determinants of spending components, see Blender and Mazzini on inventories, Chirinkle on business fixed investment, and Balding on housing. Further, in the relatively few cases in which evidence for a cost of capital effect is found, the non-neoclassical determinants of spending typically remain significant. Empirical studies that have tested the neoclassical model in its equivalent Tobin's Q formulation have generally been no more successful. Beyond the problem of weak cost of capital effects in estimated spending equations, there is a presumption that monetary policy should have its strongest influence on the short-term interest rates. For example, the federal funds rate, the most closely controlled interest rate in an overnight rate. Conversely, monetary policy should have a relatively weaker impact on long-term rates, especially real long-term rates. It is puzzling, therefore, that monetary policy apparently have large effects on purchase of long-lived assets, such as housing or production equipment, which to the extent that they are sensitive to interest rates at all, should be responsive primarily to real long-term rates. These gaps in the conventional story have led a number of economists to explore whether imperfect information and other frictions in credit market might help explain the potency of monetary policy. Collectively, the mechanisms that have been described in the literature are known loosely as the credit channel of monetary transmission. In this article, we summarize our current view of the credit channel and its role inside the black box of monetary policy transmission. We don't think of the credit channel as a distinct, freestanding alternative to the traditional monetary transmission mechanism, but rather as a set of factors that amplify and propagate conventional interest rate effects. For this reason, the term credit channel is something of a misnomer. The credit channel is an enhancement mechanism, not a truly independent or parallel channel. Moreover, this nomenclature that led some authors to focus, inappropriately in our view, on the behavior of credit aggregates, a point that we discuss later. However, it is probably too late to change the terminology now. According to the credit channel theory, the direct effect of monetary policy on interest rates are amplified by endogenous changes in the external financing premium, which is the difference in cost between funds raised externally by issuing equity or debt and funds generated internally by retaining earnings. The size of the external finance premium reflects imperfections in the credit market that drive a wedge between the expected return received by lenders and the costs faced by potential borrowers. According to the credit view, a change in monetary policy that raises or lowers open market interest rates tends to change in the external finance premium in the same direction. Because of this additional effect of policy on the external finance premium, the impact of monetary policy on the cost of borrowing broadly defined and consequently on real spending and real activity is magnified. Why should actions taken by the central bank have any effect on the external finance premium in credit markets? In this article, we describe two possible linkages. The first of these, the balance sheet channel, stresses the potential impact of changes in monetary policy on borrowers' balance sheets and income statements, including variables such as borrowers' net worth, cash flow, and liquid assets. The second linkage, the bank lending channel, focuses more narrowly on the possible effect of monetary policy actions on the supply of loans by depository institutions. In our view, the existence of a balance sheet channel seems fairly well established. The bank lending channel is more controversial. Institutional changes during the past 15 years also have rendered the bank lending channel, at least as traditionally conceived, somewhat less plausible. On the other hand, certain other developments may have increased the importance of bank lending in monetary transmission. In this paper, we do not attempt to draw strong conclusions about the relative importance of the balance sheet and bank lending channels. Instead, we try to make the case for the broader view that allowing for a credit channel of some type is important for understanding the response of the economy to changes in monetary policy. And today I will also continue to talk about the part under the introduction. So the second section is how the economy responds to monetary policy shocks, facts and puzzles. To set the stage for our discussion of how monetary policy works, We first fill in some of the details about what happened in the economy after a change in monetary policy occurs. We do so by extending recent empirical work on the effect of monetary policy to consider its impact on some key components of GDP. We emphasize four basic facts about the response of the economy to monetary policy shocks. Fact 1. Although an unanticipated tightening in monetary policy typically has only transitory effects on interest rates, a monetary tightening is followed by sustained decline in real GDP and the price level. Fact 2. Final demand absorbs the initial impact of the monetary tightening, falling relatively quickly after a change in policy. Production follows final demand downward, but only with a lag, implying that inventory stocks rise in the short run. Ultimately, however, inventories decline, and inventory disinvestment accounts for a large portion of the decline in GDP. Fact 3. The earliest and sharpest declines in final demand occur in residential investment, with spending on commercial goods close behind. Fact 4. Fixed business investment eventually declines in response to a monetary tightening, but it lags behind those of housing and consumer durables, and indeed behind much of the decline in production and interest rate. That's all for today's reading. Thank you for your listening.